Good afternoon from CPA Canada in Toronto. My name is Pam Campanoni, a Principal in Research, Guidance and Support at CPA Canada, and I'm pleased to welcome you to today's webinar, Canadian Public Company Financial Reporting Update for the first quarter of 2017. We have over 1,600 registrants for today's session. Should you have any questions during the presentation, please submit them using Ask a Question panel at the right of your screen, and we will answer as many possible during the Q&A segment. The PowerPoint slides, webinar evaluation, and any supplemental materials are available under the resources icon at the bottom of your screen. This webinar qualifies as verifiable CPD pending successful completion. The requirements include viewing at least 45 minutes of the webinar and correctly answering all the questions on the quiz. You may have multiple attempts on the quiz. The quiz is available under the orange quiz icon at the bottom of your screen, and your statement of completion will be available under the certification icon. At the end of the webinar, time will be limited before the webcast closes. The on-demand version will be available within 24 hours of closing, at which time you will be able to complete the necessary requirements to earn your verifiable CPD. On behalf of CPA Canada, it is now my pleasure to introduce today's speakers, Janet Stockton and Mark Priestley. Let me provide a brief background on our speakers. Our first speaker is Janet Stockton. Janet is a national professional standards partner at BDO and provides practice leadership and promotes audit quality for the firm. She consults with clients on matters including securities regulations, auditing and financial reporting, as well as the development of technical accounting training and publications. Janet has over 30 years of experience in the audit and accounting practice, with exposure to various levels of organizations and industries such as mining, real estate, and construction. She acts as a gatekeeper for foreign filers into Canada, including Australia, Europe, India, and the U.S. Our second speaker today is Mark Priestley. Mark is BDO's National Accounting Standards Senior Manager. Mark's responsibilities on the national team include providing technical guidance related to international financial reporting standards and public sector accounting standards. Mark has particular industry experience in insurance entities and financial services. He also supports engagement teams in dealing with the complex accounting issues, develops BDO courses and tools related to accounting and financial reporting, and writes internal and external accounting publications. Please join me in welcoming Mark and Janet to today's webinar. So Janet, I'll hand it over to you.
Thank you very much. Let's start today with the regulatory. We're going to do a regulatory update as always, an IFRS update, and just looking at the ISB's work plan. So let's begin with a regulatory look, which is a little bit noisier than we thought when we first started looking at what happened this quarter. So in April this year, the Canadian Securities Administrators issued a consultation paper and is looking for input from all stakeholders on ways to reduce the regulatory burden for non-investment fund reporting issuers without compromising the investor protection or the efficiency of the capital market. The consultation paper sets out a number of potential options, and the CSA is requesting comments on those options and encouraging all responders to put forward any other options that they have not yet identified. Well, given that the market in Canada for reporting issuers has a very significant component of venture issuers, considering and responding to this consultation paper is really important, and not taking the time to consider it and respond to it could mean a critical missed opportunity to bring forward innovative ways of thinking for disclosures in the equity and debt markets in Canada. In the appendices to the consultation paper, you can see the makeup of reporting issuers with the various exchanges in Canada, and you'll notice that 5% of reporting entities make up 31% of the market cap of reporting issuers, and they're all in the financial services industry. In the meantime, 73% of reporting issuers make up only 36% of the market cap in Canada, all with an average market cap of less than $500,000. There are many, many small reporting issuers in Canada. But before diving into the paper, we should just consider briefly the initiatives introduced more recently by the CSA and enacted in the various provinces to support reporting issuers while still maintaining investor protection. Some of the things they've done recently are liberalize the prospectus marketing regime by increasing the range of permissible pre-marketing and marketing activities in connection with public offerings. They've introduced new exemptions for use by reporting issuers, prospectus exemptions, and amended or modified certain existing prospectus exemptions available to reporting issuers. And they've tailored the disclosure and other requirements to alleviate certain requirements for venture issuers in the prospectus and continuous disclosure regimes. A significant change across the provinces was the enactment of changes to the prospectus regime and a form of partial harmonization in prospectus exemptions. These changes provided more opportunities for entities to raise funds in the public market with substantially reduced regulatory requirements. While for some provinces the regulatory requirements may have been strengthened, overall the ability of exempt offerings was increased while the disclosure requirements were decreased. And we saw a lot of activity in the crowdfunding exemption, with the offering memorandum exemption now in Ontario, and the Friends, Family, and Business Associate exemption that was introduced across the provinces. Yet, in another initiative for reducing regulatory burden, the CSA, as implemented by the Securities Commissions of the provinces, made targeted amendments for venture issuers. These changes were implemented in 2014, including allowing venture issuers to meet the interim MD&A requirement by simply filing a quarterly highlights document, by using a new tailored form of executive compensation disclosures, which significantly reduced the complexity of that disclosure for venture issuers. They increased the significance threshold of an acquisition from 40% to 100% in determining whether an acquisition is significant for purposes of filing a BAR. And they reduced the number of years of company history and audited financial statements required in a venture issuer IPO prospectus from 3 years down to 2. The amended regulations also made changes to the numbers and the members of a venture issuer's audit committee and strengthened that area as well. But at this time, and in this consultation paper, we're being asked to respond to the options brought forward by the CSA. The administrators have defined 5 categories of options with multiple approaches or proposals within each option. And the 5 areas that they're looking at of discussion include perhaps extending the application of these streamlined venture rules to other small reporting issuers. They're looking at reducing the regulatory burden associated with prospectus rules and offering process. They're looking at reducing ongoing continuous disclosure requirements, or alternatively for all reporting issuers, or just a special defined group of reporting issuers. They're looking at eliminating some of the overlap in regulatory requirements and enhancing the electronic delivery of documents. So let's look a little bit further into these categories to understand some of the actual proposals they've put forward. And I'm going to give you just a couple within each of the 5 categories that they brought forward, just to give you a flavor of what they're introducing. If you want to see the full list of options that they're considering, you will have to go to the paper, and it is quite extensive, the number of options they're looking at. So currently, streamlined rules are available to venture issuers. The CSA is considering other metrics for providing streamlined rules, such as perhaps adopting a size-based distinction where a reporting issuer's size could be measured, for example, by the size of its assets, the amount of its revenues, its market cap, or some combination thereof. This would provide smaller issuers that are currently traded as non-venture issuers the ability to make use of these streamlined rules. Some of the questions that the CSA is posing to us as stakeholders would be, is a size-based distinction between categories of reporting issuers preferable to the current distinction, which is based on the exchange that you're listing on? Or if they were to adopt a size-based distinction, what would be the appropriate metric? And how would reporting issuers deal with changes in those metrics year over year? Looking at regulatory burdens associated with the prospectus rules and the offering process, an issuer may actually choose to list as a non-venture issuer at the time of its IPO, even if it has relatively low revenues. The CSA is considering whether to allow issuers that intend to list on a non-venture exchange to present a reduced number of years of audited statements in their IPO prospectus if they have pre-IPO revenues under a certain threshold. Potential other options in the prospectus model would include increasing the bar thresholds for non-venture issuers, just as they did for venture issuers, although perhaps not to the same extent. What about removing the requirement to have interim financial statements reviewed by the auditor, or removing the requirement for pro forma information for significant acquisitions in a prospectus or other document with prospectus-level disclosures? The CSA is considering options related to the short-form prospectus offering system, eliminating or modifying the disclosure requirements in the short-form offering. Other alternatives could be increasing the focus on a reporting entity's continuous disclosures to allow for more concise offerings, or to provide an option for the at-the-market or ATM offerings. When considering ongoing disclosure requirements, the CSA has considered comments from preparers on the time and the cost of preparing business acquisition reports, and from stakeholders on the value of pro forma information in some transactions. And as a result, the CSA is considering a review of bar requirements. They would consider removing the requirement to file a bar entirely in certain circumstances, removing one or more of the significance test, or increasing the thresholds applied to the 3 significance tests for non-venture issuers, and maybe providing alternative tests based on specific industry criteria. They've got a lot of ideas going on in the business acquisition reporting process. They've also looked at annual and interim filings, and they're proposing the idea of removing the discussion of prior period results from the MD&A, maybe removing the summary of quarterly results for the 8 most current recently completed quarters in the MD&A, and allow all reporting issuers to meet interim MD&A requirements by preparing a quarterly highlights document. How about considering the idea of allowing semi-annual reporting as opposed to quarterly reporting, and allowing for more focus on the creation of value by a business over the long term? Well, as many of us has noted, there is duplication in information disclosed to investors through the many regulatory required documents. Not only that, the framework for financial reporting under IFRS includes more and more disclosures that were previously only discussed within the context of the MD&A for reporting issuers in Canada. Consequently, the CSA is considering the elimination of duplication of information. For example, between financial reporting and the MD&A, there could be an elimination in the MD&A for the need to discuss critical accounting estimates or changes in accounting policies or contractual obligation information, which is all finding its way into the financial statement on which are audited. There's also the potential overlap in disclosure requirements in the continuous disclosure forms. For instance, both the MD&A and the AIF require a form of discussion on the risks associated with reporting issuer, and oftentimes we find those risks duplicated entirely between the 2 documents rather than seeing and attempting to see the sensitivity of the difference between those documents. So in summary, this is really an opportunity to critically look at the regulatory requirements for reporting issuers in Canada. As you go through this paper, it outlines specific questions that the CSA would like you to consider and respond to. The response date for the comments in this paper is very short. It's just in July, and we encourage you all to take the time to do this. So otherwise, is it all quiet on the regulator front? Not so. While there were no new regulations that came into force impacting financial reporting for reporting issuers this quarter, the securities regulators continue to look at initiatives towards a better capital market in Canada, both providing protection to investors and an environment conducive for raising funds and trading in securities in Canada. So in addition to its activities related to regulatory burden, the CSA performed a review of the communications made by reporting issuers across the span of venues from formal filings to social media outlets, and provided their findings in a report to the public. The BC Commission published guidance and resources for technology companies that are operating or planning to operate in BC. So looking at the CSA's report on social media in the spotlight, as we all have experienced, information flowing to us flows to us through a myriad of social media applications, and this has emerged in recent years and has become a common and important venue for reporting issuers to connect with potential customers, their shareholders, and any other security stakeholders. Securities regulators are increasingly interested in the disclosures made through social media within their security reporting obligations. From their public communications, the regulators want reporting issuers to be aware of the securities reporting obligations that their social media activities may trigger, even if these activities are not directly intended to communicate with investors. They go on to say that given that the investment decisions are made on material information, it is critical for issuers to adhere to a high-quality disclosure practice, regardless of the venue used for dissemination. So as a result, a review was completed by the staff of the CSA, and a staff notice was published based on a study of 111 reporting issuers. The CSA noted that while a majority of the issuers in their sample that used social media did not raise securities-related concerns, they still considered the results to be significant, as 30% of the issuers in the sample ended up taking action to improve their disclosures in response to the issues raised by the CSA. Under the Securities Regulation Disclosure Standard, it is considered fundamental that everyone investing in an entity's securities should have equal access to information that would be reasonably expected to have an impact on their investment decision. More specifically, material changes as defined by the regulation must be disclosed in a news release. So in their survey, the CSA cautioned reporting issuers about some of their concerns. Unbalanced and misleading disclosures, providing more positive discussions than neutral or negative disclosures when necessary. Selective disclosures, highlighting only those aspects of the entity that were positive. When releasing forward-looking information, making it clear that the information is forward-looking, how it's developed, and what factors or events have occurred that would impact previously disclosed forward-looking information. The lack of coordination about the timing of social media announcements when information that needs to be disclosed or filed on CDAR was getting filed after the information was released through a social media venue, which is not considered a venue available to all investors. In some cases, the CSA noticed there was information posted by third-party posts on social media, suggesting there might be missing continuous disclosures by the reporting issuer themselves. And also there's just concern about misleading or untrue statements being provided. And sometimes it would appear the company would reference analyst reports and other articles with a bias to reference only those comments that are supporting the company in its operations and activities. As expected, the CSA strongly recommends that companies should implement a governance framework over information posted in the social media realm. Decisions on controls over who can post, what can be posted, when items can be posted, where items will be posted, and how such postings will be approved and monitored. And they actually say that the process should also include the monitoring of information posted by third parties about the company. Going on to the BC Commission, as part of their consultation work, the BCSC conducts surveys with various businesses and stakeholders active in the tech industry. They're looking at the industries that the Securities Commission is currently regulating, companies such as robo-advisors, online lenders, and crowdfunding portals. For all of you like me, robo-advisors are firms that provide financial advice or portfolio management online with minimal human intervention. The digital advice that they provide is based on mathematical rules or logarithms based on the information under Know Your Client that is submitted by an individual. The entities behind these advisors are either registered as portfolio managers or investment dealers, and to date that I've checked, the BCSC has registered 10 robo-advisory firms. Online lenders use the internet to process loan applications and assess creditworthiness of potential lenders, once again with minimal human intervention. And of course, we've all heard about crowdfunding portals that are used to raise a small amount of money from a large amount of people. Crowdfunding portals used to raise equity in a company are regulated by the Securities Commissions in Canada. And the BCSC has published a specific guide for funding portals if you or your clients would like to understand more about this type of equity raising in Canada. The funding portals must be registered with the BC Commission unless they received exemption relief from doing so. I've got another message for a strong notice to any reporting issuers listening in, for reporting issuers in the U.S. In 2009, the SEC had adopted rules requiring companies to provide financial statement information in a form that was intended to prove its usefulness to investors. The format was intended and currently allows users of financial statements to download information directly into spreadsheets for further analysis. The rules applied to public companies and foreign private issuers that prepare their financial statements in accordance with U.S. GAAP and foreign private issuers that prepare their financial statements using IFRS. But there is a phase-in period adopted by the U.S. that until recently, foreign private issuers filing in the U.S. under IFRS were not required to submit their financial statements in XBRL format. The SEC was waiting until such time as a taxonomy for IFRS was completed. Well, in March 1st, 2017, the Commission published an XBRL format for reporting issuers that prepare their financial statements in accordance with IFRS. Now, although the existing rule would require foreign issuers to prepare their financial statements to submit that financial data in XBRL format upon publication of the taxonomy, the Commission did provide a notice that such issuers may first submit financial data in XBRL with their first annual report on Form 20 or Form 20F or 40F for a fiscal year ending on or after December 15th, 2017. So they have given you time to look at the new format and get ready for it. And those of you who are impacted are reminded that this process will add time to your filing process. And that time could be significant based on what happened when it first came through for domestic issuers. You should download the templates during the year to determine the amount of work that will be required to map your current trial balance to the XBRL format. And another notice coming out from the PCAOB and the SEC, which primarily impacts auditors, but it may be of interest to those looking at auditors, the responsibility of the auditors. For each audit report that an auditor issues for an issuer, a registered public accounting firm must file with the PCAOB, the Public Company Accounting Oversight Board in the U.S., a report referred to as Form AP. And this form must be filed for the first time the audit report is included in a document filed with the Commission. So effective for audit reports issued on or after the 31st of January of this year, 2017, the form includes the name of the engagement partner along with a 10-digit unique identifier for that partner and additional information regarding the engagement partner. In addition to that, after June 30th, 2017, there will be more information, including the names, locations, and extent of participation of other accounting firms that took part in the audit if their work constituted 5% or more of the total audit hours. Also, we'll have to discuss the number and aggregate extent of participation of all other accounting firms that took part in the audit that individually contributed less than 5% of the total hours. And this AP is deemed to be filed timely if it's filed within 35 days after the date of the audit report is first included in a document. If such a document is a registration statement, the form is actually required 10 days after the audit report is included in the document. Now, I don't have time, and I didn't get to bring in a discussion on April 25th when the CSA issued a consultation paper related to the desirability and feasibility of reducing requirements for the oversight of work done by foreign auditor firms related to the audit of reporting issuers' financial statements. The proposal has come from the Canadian Public Accounting Board, and with this proposal, the comments are due in June of 2017. So we won't be able to go over those in time for the reporting deadline for that. And now I'll pass it on to Mark.
Thanks, Janet. So I'm going to go over some accounting reminders and IFRS news and what's been going on in the accounting world. So we're going to talk about some new and amended standards and interpretations that have been recently put out, some IFRS discussion group update based on what's happening in IFRS in Canada. We're going to look at the IFRS Interpretation Committee's recent agenda decisions, and then also take a brief look at the IASB work plan to see what they have in their plan for the near future. So we'll first look at some new and amended standards. So we're going to look at three things. We're going to look at IFRS 22 foreign currency transactions and advanced consideration, which is a brand new standard that was put out by the IFRS Interpretations Committee, that's IFRS. We're going to talk about some annual improvements, which tend to be more editorial or narrow scope amendments to standards. And then we're also going to look at one other small amendment that's been made relating to transfers of investment properties within the scope of IAS 40. So IFRS 22 is foreign currency transactions and advanced consideration. So what it's meant to do is to clarify how entities should measure assets and liabilities and items of income expense when consideration is paid in advance. So for example, when an entity receives a deposit as deferred revenue prior to revenue being recognized, and there's a time lag between when those two events occur, and there's a shift in the foreign currency rate. The IFRS is really put out to clarify at what amount the ultimate amount of the item is meant to be recognized at. So it was issued on December 8th, 2016, and is effective for periods beginning on or after January 1, 2018. So let's take a look at some of the detail of this IFRS. So IFRS 22 applies to foreign currency transactions that result in the recognition of a non-monetary asset or liability arising from the payment or receipt of consideration before the entity recognizes the related asset or expense, except for payments and receipts relating to income taxes and insurance contracts. IFRS 22 also does not apply to assets, expenses, or income that are initially measured at fair value. So for example, a business combination scenario, or also items that are required by another IFRS to be recorded with reference to fair value. So for example, a non-monetary consideration received within the scope of IFRS 15, revenue from contracts with customers. So some common situations where IFRS 22 will play include purchase and sales of PP&E, intangibles, and investment property, purchases of inventory or services, entry into lease contracts, and receipt of some government grants. And as I had said earlier in the previous slide, it would also come into play when there's been advanced consideration relating to the recognition of revenue. But let's look at an example or two that kind of illustrates the issue of why this was brought to IFRS and the kind of the clarification that they're providing. So in this situation, we have ABC Company as a Canadian manufacturer whose functional and presentation currencies are both the Canadian dollar. ABC Company receives a deposit from a customer of USD 100 on March 1, 2019 to be applied against a future order of widgets. As the widgets were not shipped, ABC Company deferred revenue when the money was received. The widgets are shipped on May 15th, 2019, and ABC Company recognized revenue. So the foreign exchange rates were as follows on these dates. So when the deferred revenue was recognized, when the cash was received, the rate was 1.15, and then when the actual revenue was recognized, the rate was 1.17. So the question that was raised to IFRS was when revenue is recognized on May 15th, 2019, at which rate is the revenue recognized? Is the deferred revenue simply reclassified to revenue so that the revenue would be 115, or is there a remeasurement, so to speak, with a resulting foreign exchange gain or loss such that revenue would be 117? So the consensus that was put out by IFRS is that the date of the transaction for the purpose of determining the spot exchange rate used to translate the related asset, expense, or income, or part of it, on initial recognition in accordance with IAS 21 is the earlier of two dates. A is the date of initial recognition of the non-monetary prepayment asset or the non-monetary deferred income liability, and B, the date that the asset, expense, or income, or part of it, is recognized in the financial statements. So if we apply this guidance to the fact pattern that we just had, A, which is the date of initial recognition of the non-monetary prepayment liability, is March 1, 2019, and B, the date that the asset, expense, or income is recognized is May 15th. The earlier of those two dates is March 1, 2019. Therefore, approach A is the correct approach, and revenue was 115. I think, broadly speaking, this is the approach that most entities take, though IFRS did observe some inconsistency in their outreach, so they felt that this needed to be clarified. Let's look at one more example. So if we take pretty much the same fact pattern as before, but change it slightly such that the amounts of deposits were received over different points in time. So, for example, instead of $100 being paid at one point, say that there was a 20, a 40, and another $40 USD paid at various points in time between the initial payment and the time in which revenue was ultimately recognized. The IFRS opinion of this is that if the transaction is recognized in stages, including any non-monetary prepayment assets or deferred income liabilities, then a date of transaction is also established in stages. So in this fact pattern shown on the slide, you would have to translate the deferred revenue at the spot exchange rate at each point in time when the deferred item is recognized. Then you would end up with sort of a blended deferred revenue item that would ultimately be recognized in revenue when the widgets are shipped. Okay, so now we're also just going to briefly discuss the annual improvements that have been made to IFRS. So just as a reminder, the annual improvements are kind of narrow scope types of amendments that the IASB makes relating to sometimes editorial changes or things that are felt to be very narrow scope in nature. So there's three that we're going to briefly discuss. The first relates to an amendment to IFRS 1, which is a standard on first-time adoption of IFRS. It's simply just removing some short-term exemptions from some of the subsections of IFRS 1 relating to IFRS 7 and a couple other different standards that are no longer applicable because the date at which those standards became applicable has now passed. So any entity that was to adopt IFRS in the future, those exemptions would no longer be relevant. So they simply have been removed from the standard. Another amendment relates to IFRS 12, which is disclosure of interests in other entities. The clarification states that simply because an item, which may be a subsidiary, is classified as held for sale within the scope of IFRS 5, that doesn't relieve entities of making the disclosures that are applicable within IFRS 12, except for a couple specific exemptions that are made explicitly within the standard of IFRS 12. There was some application confusion relating to whether an entity could avoid all of the disclosures within IFRS 12. So this clarification simply states that it's only the ones that are specifically discussed as not being required within the standard. And the final one that we're going to discuss relates to investments in associates and joint ventures, IAS 28. It clarifies that venture capital organizations, mutual funds, unit trusts, and other similar entities may choose on initial recognition on an investment by investment basis, whether they wish to use the fair value for each underlying entity or use the equity method. There was confusion relating to whether they could make that choice on an investment by investment basis or it had to be all or nothing. So this amendment clarifies that. Okay, and then finally, in terms of newer amended standards, we're also going to briefly discuss an amendment to IAS 40 investment property. So the amendment clarifies that a change in management's intention is insufficient in and of itself to justify a previously recognized property from being reclassified to or from investment property category. The reason this is important is because if an item is within the scope of IAS 40 investment property, there's some very different measurement standards and options that are available to entities relating to that property as opposed to when it's within the scope of IAS 16. So there was some confusion and some inconsistency in how entities were applying the provisions of when you can move in and out of IAS 40 relating to that measurement. Some entities were reclassifying in and out of IAS 40 simply based on management's intention or future plans with those properties, but this amendment clarifies that management's intention in and of itself isn't sufficient. You'd have to look at all of the other criteria within IAS 40 relating to reclassification. So now we're going to briefly discuss the IFRS discussion group update. So as a reminder, the IFRS discussion group is a group of preparers and also firms and some regulators that get together several times a year to discuss the application of IFRS in a specific Canadian context. They don't technically have the ability to formally interpret GAAP. However, their discussions are often very useful and insightful in applying IFRS in a Canadian context. So the issues that we have on this slide here, we're not going to cover in detail as they're a little more narrow in scope, though if any of them seem like they're of particular interest to you, the discussion papers and notes are available on the FRAS Canada website if you'd like to read them. But here are some of the topics that we are going to discuss. So the first relates to the settlement of a shareholder loan. So the issue is, how should an entity account for any difference between the fair value of the consideration paid and the carrying value of the shareholder loan extinguished? So it's a little easier to understand the particulars of this situation if we use a fact pattern. So say, for example, that an entity has a loan that is due to a significant shareholder, and the loan is and was on issuance convertible at a previously agreed conversion price. The entity is unable to actually repay the loan, and the effect on the entity's financial position is very significant and is reducing the entity's ability to raise additional forms of financing that are needed. So the entity and the shareholder agree to convert the amount owing into common shares and to do so on favorable terms. The conversion price agreed to is higher than the current market price of the entity's common shares, and the fair value of the common shares issued is less than the carrying amount of the loan. So the reason this was brought to the IFRS discussion group is that IFRS 19, which is the standard on extinguishing financial liabilities with equity instruments, technically scopes out transactions with shareholders in their capacity as shareholders, though this fact pattern that we just put forward is actually very common in practice. So the IDG's discussion was that if it's determined that a creditor is acting in his or her capacity as a shareholder, it would be appropriate to recognize the difference in equity or to measure the common shares of the carrying value of the liability extinguished. So this is to say that if a creditor is acting as a shareholder, then really they're kind of acting for the benefit of the business, so there shouldn't be an amount recognized in profit or loss based on the derecognition of the financial instrument. But one item that the IDG just wanted to make clear is that you can't simply jump to a conclusion that simply because someone is a shareholder that you would get to this treatment. You have to look at the significance of the shareholding and how exactly they're interacting with the business in that particular transaction. Okay, so now we're going to talk about sources of exchange rates used in IAS 21. So historically, the Bank of Canada has published the noon and closing foreign exchange rates for 55 currency pairs. The noon rate exchange rate for the Canadian dollar against the US dollar is calculated to reflect the trades that take place between 11:59 a.m. and 12:01 p.m. All other Canadian dollar noon exchange rates are derived from the Canadian US dollar exchange rates and from indicative wholesale market quotes from a broad array of other currencies. The closing rates are updated at 4:30 p.m. daily. So all Bank of Canada exchange rates are indicative rates only, derived from averages of transaction prices and prices quoted from financial institutions, and are sourced from Thomson Reuters. So on February 16, 2016, the Bank of Canada announced that effective March 1, 2017, it will reduce the number of currency pairs published from 55 pairs to approximately 25 pairs, and it will no longer publish noon and closing rates, but rather a single indicative rate per currency pair each day. This rate will be a daily average rate calculated using a methodology that will reflect the average exchange rate observable throughout the Canadian business day. The details of the bank's methodology are expected to be publicly released in the fourth quarter of 2017. So paragraph 21 of IAS 21, the effect of changes in foreign exchange rates, states that a foreign currency transaction shall be recorded on initial recognition in the functional currency by applying to the foreign currency amount the spot exchange rate between the functional currency and the foreign currency at the date of transaction. And paragraph 22 of IAS 21 states that the date of a transaction is the date on which a transaction first qualifies for recognition in accordance with IFRS. So for practical reasons, a rate that approximates the actual rate at the date of transaction is often used. For example, an average rate for a week or month might be used for all transactions in each foreign currency occurring during that period. However, if exchange rates fluctuate significantly, the use of the average rate for a period is inappropriate. Paragraph 23A of IAS 21 states that at the end of each reporting period, foreign currency monetary items shall be translated using a closing rate. So after summarizing all that, the issue that was brought to the IFRS discussion group simply was, well, what are the implications of this change in policy from the Bank of Canada in applying all of those requirements that we just spoke about in terms of IAS 21? Issue 1 is, will the new daily rate be acceptable as the spot exchange rate for initial recognition of foreign currency transactions? Group members agreed that the issue would warrant consideration of the facts and circumstances surrounding the transaction, and the materiality may be an important factor considering how much the foreign currency amounts move from period to period. Issue 2 is, will the new daily rates be acceptable as the closing rate to translate foreign currency monetary items at the end of the reporting period? The group's discussion members supported generally a view noting that the indicative daily rate cannot be used because a closing exchange rate is clearly a point-in-time measure, not an average, though the group members, again, did stress that you'd have to consider the application of materiality in this instance. On issue 3, under IAS 21, will the new indicative daily rate for the 25 currency pairs be acceptable as the closing rate to translate assets and liabilities for an entity whose functional currency is not the presentation currency, or for a foreign currency within a reporting entity into a presentation currency? And the group's discussion members agreed that this issue is analogous to the previous one and supported that indicative daily rates could not, technically speaking, be used. And issue 4 is, what other foreign currency exchange rate sources might entities use when the Bank of Canada's indicative daily foreign exchange rates cannot be used because they are not appropriate under IAS 21. The group's discussions were to raise awareness of this item, and group members suggested that entities need to look at a variety of different options depending on the materiality and the particulars of their own situation. So for entities concerned about this change in policy for the Bank of Canada, they might want to look at the past history of differences between these indicative and closing rates to determine the materiality of the issue. So now we're going to discuss another topic from the IFRS discussion group. So this relates to changes in tax rates for indefinite life intangible assets. And this issue was brought up related to a recent IFRIC agenda rejection. So the IFRIC was asked how to clarify how an entity would determine the expected manner of recovery of indefinite life intangible assets when there's measurement of deferred tax. And the reason that this matters is that IAS 12 provides guidance on determining the tax basis, which feeds into the deferred tax calculation. But IAS 12 states that the tax basis may depend on the underlying manner of recovery of the asset. So for example, in Canada, if a manner of recovery is expected to be sale, there could be capital gains type tax consequences, and if the expected manner of recovery is sale, there would be different consequences. So the tax base might depend on what the intended use of the item would be. But IFRIC recently clarified that on an indefinite life intangible asset, it is not appropriate to necessarily 100% always presume that the manner of disposal will be sale. The reason that this was brought up is because IAS 12 states that for items not subject to amortization, for example, land, you must presume sale as being the manner of recovery because that's the only way the item will ever be derecognized. But an item with an indefinite useful life isn't necessarily not subject to amortization. Its useful life is simply unknown at this given point in time. So entities do have to make particular assessments. So after explaining that, the reason this was brought up to IFRIC is that it brought up a couple issues. One issue is, should a change in the deferred tax rate arising from the IFRIC agenda decision be considered to be a change in accounting policy or a change in estimate? So the reason this question is being brought up is if entities had accounted for the transaction differently than what IFRIC had brought up, how would they account for this change? IDG stated that they felt that this was not a change in estimate. It was a change in the underlying meaning and interpretation in the gap, which is fundamentally accounting policy. So therefore, it would be accounted for retroactively. Issue 2 is that if the accounting policy change arising from issue 1 is followed through with, and the indefinite life intangible asset arose from a business combination for which the measurement period has elapsed, how would the retroactive adjustment be presented? So in the situation where the 1-year measurement period that has elapsed in a business combination, would an entity still be allowed to go back and restate necessarily? They stated that this is an issue separate from the measurement period, so an entity would be required to go back and restate their figures if they accounted for it as a change in accounting policy. So now we're going to discuss some IFRS Interpretation Committee agenda decisions. It's important to note that these are agenda decisions, not necessarily actual interpretations put out by IFRIC, but often the items that they reject from their agenda provide a little bit of insight. So we'll look at the first 3. The commodity loans transaction issue is a little narrow in scope, but if you'd like to read the agenda decision, it is also available online. This first relates to the interpretations in IFRS 10 for investment entities and subsidiaries. So a couple questions that were posed to IFRIC and they rejected from actually clarifying, but they provided some insight on were, does an entity qualify as an investment entity if it possesses all 3 elements as described in paragraph 27 of IFRS 10, but does not have one or more of the typical characteristics of an investment entity listed in paragraph 28 of IFRS 10? The IFRIC stated that this was maybe, and it would depend on the weighting of the circumstances. B, does an entity provide investment management services to investors if it outsources the performance of these services to a third party? IFRIC stated that yes, the outsourcing doesn't change the fact pattern. C, to what extent can an investment entity provide investment-related services itself or through a subsidiary to third parties? IFRIC's opinion was that it must be ancillary to core investing and not change the business purpose of the entity overall. D, does a subsidiary provide services that relate to its parent investment entity's activities as specified in paragraph 32 by holding an investment portfolio as a beneficial owner? The answer was no. This would probably be done for tax purposes or things that are not substantive. The next item is a clarification related to IAS 12 again, relating to income taxes. So because there is sort of an embedded deferred tax item in the corporation that's inquired relating to the difference between the tax basis and the carrying value of the item. IFRIC stated that the initial recognition exemption does apply and all of the transaction price must be allocated to the investment property. And the final item, again, relates to fund managers. Simply, all this is stating is that when a fund manager holds an investment, at least partially, that it is managing, they do have to apply the guidance within IAS 28 relating to determining whether they have significant influence. They would not look to IFRS 10 or other standards or any other specific guidance to determine whether they have significant influence. In terms of the IASB's work plan, they do have a lot of projects on the go right now. A lot of them relate to the disclosure initiative, which is their broad plan looking at improving the usability and functionality of financial statements. In terms of standard setting and related projects, the one item that we will point out is that the final standard for insurance contracts that has been worked on for nearly 20 years at this point is likely to come out later this month. So entities that are concerned with IFRS 17 and insurance contracts should look out for that, as it will be coming very shortly. And then in terms of ISB documents, they're open for comment. There's an exposure draft on improvements to IFRS 8 for operating segments, which is open right now, as well as their discussion paper on disclosure initiative, principles of disclosure, which looks at how entities determine what disclosures are appropriate for their financial statements.
Okay, thanks, Mark. That was great. I'm just going to briefly touch on some CPA Canada resources. Just some relatively new publications that have come out. We have State of Play, which is a study of climate-related disclosures by Canadian public companies, and also Climate Change Briefing discusses questions for directors to ask. Moving to the next slide, we're just going to quickly point you out to the 2000 in 17 IFRS conference on November 1st to 2nd in Toronto, Ontario, which is jointly presented by CPA Canada and the IFRS Foundation, helping get critical insights into the latest IFRS updates and networking with business leaders and fellow IASB members looking at the future of financial reporting around the globe. And one other quick topic I will point you out to is CPA Canada's Corporate Reporting Awards. Entries are now open for the Awards of Excellence in Corporate Reporting. It's a great program for issuers because you receive confidential feedback from the judges in 4 categories: financial reporting, electronic disclosure, sustainability reporting, and corporate governance disclosures. It's a great way to assess how you are doing and where you can improve, and the opportunity to win an award for excellent work is a great motivator for your team. So just an FYI, entries are open until June 30th. So if you want more information about this program, feel free to give Bernie Sutton at CPA Canada a call at 416-204-3498. Now we've arrived at the Q&A portion of our session. Should you have any questions, please submit them using Ask a Question panel at the right of your screen. So let's just get into a few questions because we don't have lots of time left. This one's for Janet. Do you see any of the specific streamlining measures that the venture issuers have options to use now? Are there any particular ones that you think
Very keen on the reduction in disclosures related to compensation.
Right. Another question I have is with regards to the, the overburden study, consultation. Is there any specific area of duplicated disclosures or overlap that you think issuers or even readers out there of all the financial information would be interested in reducing if there's a duplication? We sort of mentioned a bit about it before.
For sure. With respect to financial statements, there's a lot of discussion on changes and the impact of changes in accounting policies, discussions on significant estimates. That's all now required in the audited financial statements. So duplicating that in the MD&A is just unnecessary duplication of disclosures.
Also just referring to the, I'm just looking at the SEC
it's only a format required in the U.S., so that it is what we mentioned today is the fact that foreign dual filers or foreign filers down in the U.S., foreign private issuers will have to use the new format starting next year.
Right, and it impacts their just their annual report on the Form 20F and 40F, and it's basically on or after December 15th,
right,
2017. So this has been a long time coming. The other question I had was received was about social media, and I'm sure you've maybe heard this before. Companies are dealing with anonymous posts on investment websites or blogs that could be damaging to their stock price. How should they deal with that?
It's really interesting because what the CSA was concerned about was if they found blogs or posts or social media posts about a company that really is almost insider type of information that the company should have published themselves in advance of a third party publishing them. That was the greatest concern that they had. And therefore looking at that companies should actually have a strong governance committee that does look at what is being posted outside and taking legal action where required, working with their securities lawyers where required to ensure, first of all, that they're the first to announce material information on CDAR, and secondly, just seeing what other posts are out there.
So you think it's pretty, it's obvious that the social media policy is pretty important.
Social media policy is exceedingly important because not only you're making sure you're not violating any reporting obligations with the Securities Commission, but it's a fantastic venue to reach so many your customers and everything. So everybody's using social media. It's just watching that you haven't crossed over into violating any kind of disclosure requirement.
Okay. Another quick question is, actually this one's from Mark. What's the main impact of the IFRS 22 clarifications, the foreign currency transactions and advanced considerations?
That one's probably a little bit of an all or nothing thing. I think broadly speaking, most entities were probably applying what IFRS 22 said already. It's simply in their outreach, the IFRIC noted that some entities were not doing this. They were doing the kind of the alternative approach, which led to remeasurement. So for entities that were doing the other method, there could probably be very significant changes in their financial statements, including potentially having to rework some of their systems, since foreign currency tends to be a repetitive and very pervasive issue, especially in Canada, since we have to deal in foreign currencies so often.
Another quick question. Out of the IASB work plan, there's a lot of changes going on. Are there any sort of key ones that are going to impact a lot of public companies that you would people should sort of hone in on?
For the items that we showed on the work plan, I would probably state that none of them are as important as the big three, so to speak, standards that are actually already have been issued but are just going to be effective in the near term. IFRS 9, financial instruments, and IFRS 15, revenue from contracts with customers, are effective for periods beginning on or after January 1, 2018. And IFRS 16, leases, the infamous on-balance sheet lease standard, is effective for periods beginning on or after January 1, 2019. So those are ones that I think certainly entities need to be prepared for, because also security regulators are raising concerns about insufficient disclosure in financial statements relating to entities' plans for adopting those standards.
What's the general feel about the leases implementation process going on out with public companies in Canada?
It's kind of interesting. There will be a lot of entities that maybe only have a couple real estate leases, and they can probably comply with the standard by just doing some spreadsheets and not having to rework a lot of systems. But for entities in certain industries, say for example airlines, which are very pervasively impacted, they'll probably need to be complete reworking the systems, similar with telecommunications. But I think with the big three standards all going on at the same time right now, a lot of entities are having a hard time figuring out where to put their resources, because if you're affected by two of the three, which I think most are pretty significantly, it's hard to manage that change effectively.
Okay. Well, it sounds like there's lots of changes going on. I think we've run out of time for questions. I wanted to thank Janet and Mark for an excellent, informative, and insightful presentation. To our audience, please check the resources icon for access to the PowerPoint slides, our webinar evaluation, and any supplemental materials. Please note this webinar qualifies as verifiable CPD pending successful completion. The requirements include viewing at least 45 minutes of the webinar and correctly answering all questions on the quiz. And once again, you may have multiple attempts on the quiz. The quiz is available under the orange quiz icon at the bottom of your screen, and your statement of completion will be available under the certification icon. At the end of the webinar, time will be limited before the webcast closes. The on-demand version will be available within 24 hours of closing, at which time you will be able to complete the necessary requirements to earn your verifiable CPD. Thank you all very much for participating in today's webinar. Have a great afternoon.